personally speak to a lot of large corporate entities or banks, and they've made it clear that the recent kind of like the combination of the spot Bitcoin ETF being allowed and then also the Trump victory just increased their confidence that they have a pretty long window now of the government not really being an issue with them holding Bitcoin. So any sort of tail risk concerns some of those had have been reduced. So that's if that was someone's hang up for not buying, now they can buy. And I think that's why we've seen liquidity has not really gotten much better since the election, but certainly the regulatory outlook for the space has gotten better. And so that's why I think we've seen a pretty rational price increase. If the US does a really big Bitcoin purchase, that's obviously generally good for Bitcoin. If they just do a small purchase or they kind of keep the coins they already have, then maybe that's not a big factor. But if they do some of the more aggressive ones, that could be big.
Lyn Alden starts out by reviewing the state of the macroeconomy, paying particular attention to the Federal Reserve's monetary policy and liquidity patterns. She draws attention to the ways that changes in central bank policies and fiscal spending are affecting asset prices, especially those of stocks, bonds, and Bitcoin. Alden notes that underlying structural deficits are still bringing cash back into the economy even if the Fed has delayed its balance sheet reduction. The Fed might be obliged to change course if market stress increases or economic conditions worsen, which could result in more frequent liquidity injections and volatility in asset prices. For more information about cryptocurrencies and the digital asset world, remember to like this video, subscribe to the channel, and enable post notifications if you like this kind of content. Additionally, please feel free to leave a comment below with your thoughts. Thank you for watching and enjoy the video.
Growth, would that have a negative effect on M2, and ultimately would that drag down risk assets?
All else being equal, that would be tighter monetary policy at a time when there's not really as many offsets anymore. So yes, I would think that'd be negative for asset prices. If anything, they're going to go in the other direction. So they've already tapered, like they already decreased the rate that they let treasuries mature off their balance sheet. So they've slowed down their quantitative tightening. Probably the next step is to slow it down more or stop it altogether, which we might see by the end of this year. And over the past couple of years, we've had the $2 trillion reverse repo facility drain back into the system and offset their quantitative tightening. That's now down to like 100 billion, so that can't happen again. And so there's not that many other sources of liquidity. So yeah, if the Fed got super aggressive with balance sheet reduction, I think we probably would see some challenges in the treasury market, and then that would then bleed into other markets, and we probably would see a backpedaling by some of these entities, mainly the Fed. Yeah, anything that increases regulatory certainty is helpful. So I personally speak to a lot of large corporate entities or banks, and they've made it clear that the recent kind of like the combination of the spot Bitcoin ETF being allowed and then also the Trump victory just increased their confidence that they have a pretty long window now of the government not really being an issue with them holding Bitcoin. So any sort of tail risk concerns some of those had have been reduced. So if that was someone's hang up for not buying, now they can buy. And I think that's why we've seen liquidity has not really gotten much better since the election, but certainly the regulatory outlook for the space has gotten better. And so that's why I think we've seen a pretty rational price increase. If the US does a really big Bitcoin purchase, that's obviously generally good for Bitcoin. If they just do a small purchase or they kind of keep the coins they already have, then maybe that's not a big factor. But if they do some of the more aggressive ones, that could be big. If other central banks or other sovereign wealth funds decide to accumulate meaningful positions, that matters. There's a little bit of a spreading of corporations buying Bitcoin. And so to the extent that accelerates or decelerates, that's really meaningful for price. So there are tons of non-liquidity things, like they're kind of more cultural or regulatory things that can happen. And then the other thing I look at is mainly like just on-chain valuation metrics to look for problem areas. My favorite metric is market capitalization compared to on-chain cost basis. And right now that's pretty middling. So it's not as high as it historically has been during major market tops. That's not to say that every cycle has to be the same. They could certainly change. But most of those like types of kind of fundamental valuation indicators or like kind of euphoria indicators are still not really flashing red. At a couple times they've kind of flashed like yellow, but they've not really been flashing red, which is another set of things that kind of gives me confidence for the next 18 months or so. Right. So, I mean, it's been positive to see this consolidation kind of work its way out. I probably thought the consolidation would last a little longer. I'm glad it's not because I'm long gold. Generally speaking, we've seen a little bit of rotation in buying. So before it was mainly foreign central banks and people in China and elsewhere buying. Now I think we're seeing a little bit more North American purchases that are supporting it. And a main difference between gold and silver is a lot of large entities like central banks buy gold, whereas they don't really buy silver. In addition, generally speaking, if someone is into like hard money and precious metals, gold's the low volatility one, and then they get into either silver, platinum, or miners for their higher volatility exposure if they're bullish on the space. And now, with the size of Bitcoin and to some extent other cryptocurrencies, that market's more fractured now. So I would say that Bitcoin has not really competed with gold too much because it's not really competing with the same types of buyers. Now, around the margins, it has competed, but I would say it's competed with silver and gold miners more because you're capturing kind of a hard money enthusiast with high volatility tolerance. That's a little bit more of a competing market. So I think that the options for higher volatility is a little bit more fragmented. So I'm not surprised too much to see gold kind of have a bigger breakout than say platinum or silver or the miners. And I still think long term this has room to run because central banks around the world can say I'd like to hold assets that are not seizable unless like we're literally invaded. And also I just think that there's more and more currencies having problems. I mean, the euro currency doesn't look structurally good. We already talked about U.S. fiscal dominance.
Lyn Alden provides a straightforward explanation of global liquidity, a major factor influencing asset prices. Indicators like the strength of the U.S. dollar and the growth of the broad money supply can be used to track liquidity, she says. While a weaker dollar helps to alleviate global financial circumstances, a strong currency puts pressure on nations with debt denominated in dollars. The liquidity cycle is described by Alden, starting with the stimulus-driven growth of 2020 to 2021 and ending with the tightening phase in 2022, followed by a recovery in 2023 and 2024, although she cautions that investors should remain vigilant regarding potential shifts in central bank policies and government spending. The outlook for asset prices appears to be positive through 2025. Also, a quick reminder, only a small percentage of viewers are subscribed. If you enjoy deep dives into crypto and finance, hit that like button and subscribe. It's free and helps the channel grow.
Do the stock markets need lower interest rates for a continued bull rally? I mean, is that even a relevant discussion in 2025?
They don't need lower rates. It depends what else is happening. They certainly, the cost of capital is a major input for valuation. But right now, for example, Costco is trading at like 60 times earnings, despite rates being historically high still for the modern investor time frame. So clearly, it's not like a one-to-one correlation where higher rates means lower asset valuations. There's even certain environments, and this you normally see in emerging markets, which is that higher rates can actually fuel higher asset prices because you blow out the deficit even more. And so I would actually relate things like money supply growth to asset prices more than rates per se. I think the current environment is kind of a mix for asset prices. Because on one hand, the high rates are increasing the deficit because all that interest expense is flowing out to a lot of private entities and foreign entities that own that debt and able to spend that interest, either accumulating more assets or going out and accumulating goods and services. So that's generally inflationary for asset prices. But the higher rates do put headwinds against how much you can reasonably pay for equities because, when you start to pay really super high, silly valuations, and you actually do have a pretty significant hurdle rate to clear in terms of the cost of capital, it keeps somewhat of a lid on that. And I think some of those really high valuation equities are at risk if we stay higher for longer. There are a lot of really cheap equities, both in the US and internationally. And some of these policies could be better for them than we think. I mean, if you generally have, on average, sticky high inflation, some degree of deregulation, Trump putting pressure that he wants lower interest rates, and just in general ongoing fiscal environment, I think probably U.S. banks are going to do better than expected. It's not a very liked asset class. I think emerging markets are interesting right now. Basically, very underallocated. Nobody really wants them. The last thing people want to buy in a trade war is international stuff, but some of those are actually not that affected, in my view. And so I still think amid equities, there's actually still a lot of opportunity out there. It's not like when people see the expensive U.S. market, they'll look at like market cap to GDP or the CAPE ratio. That's a collection of thousands of stocks, and there's actually plenty of areas that are trading at very normal valuations, and that, in my view, still offer better return potential than bonds. The simplest one, which is global dollar-denominated M2, so global broad money supply denominated in dollars. It's not perfect, but it's reproducible, which I think it's really useful. There are proprietary ones that are also great. I mean, Michael Howell of Cross Border Capital has he's kind of like the liquidity guru. Tons of great analysis there. So I think there's multiple reasonable ways to define liquidity, but basically what you're looking at is, domestically speaking, is broad money supply growth happening or not? And where are the sources of it coming from? Is it from bank lending, or is it from fiscal deficits? Those are kind of the two main sources. And then two, what does the international situation look like? Because if the dollar gets really strong, then all the dollar indebted entities around the world get generally squeezed because their liabilities are hardening relative to their cash flows. On the other hand, if the dollar eases, generally speaking, that's like easing their liabilities compared to their cash flows. And so some combination of the quantity of money and then also specifically the dollar in relation to other currencies, and the way to kind of put that together, the composite, is to say what is global broad money when you then translate it into dollars, because then you can map out the various magnitudes of those things. So if the dollar is strengthening, but the money supply is going up rapidly in a bunch of countries, then maybe that second factor is a bigger positive component than the strong dollar. So you kind of put those together and see what is the general direction.
Lyn Alden offers an insightful viewpoint on market dynamics, liquidity, and asset valuations in the contemporary economic environment. Although interest rates have an impact on asset prices, she contends that they are not the only determinant. There isn't a clear one-to-one relationship between rising rates and falling asset prices, as seen by the fact that businesses like Costco continue to trade at high valuations despite record high rates. Alden highlights that in certain situations, especially in emerging nations, higher interest rates can actually improve liquidity by widening budget deficits and boosting asset price appreciation. She contends that the expansion of the money supply as a whole, rather than just interest rates, is a more accurate predictor of changes in asset prices. As government debt service payments move into private and foreign hands, raising spending capacity and causing inflationary pressures, rising interest rates are a contributing factor to the widening budget deficits in the United States. She also emphasizes how crucial it is to look past the stock market's headline prices. Metrics such as the market cap to GDP ratio and the CAPE ratio make U.S. stocks look pricey overall, but there are still cheap chances both at home and abroad. Due to trade tensions and geopolitical uncertainty, emerging markets have received less attention, yet they may provide lucrative investment opportunities. Furthermore, given the current climate, U.S. banks, which have been undervalued, may do better than anticipated. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.